extra long or an extended weekend. It just means there's more reasons for people to party down here.
Sounds like a plan.
We can see you now chiming in from some beautiful. Are those are not redwoods? What are those behind you?
Those are redwoods, yes, sir. So let's just click on this. All right. Sorry, everybody, for being late. We have some Wi-Fi difficulties. Can everyone hear me? Okay.
We can. You're sporting a nice little outdoor T-shirt and everything. Right. As Brett is still struggling with some connectivity issues, some Wi-Fi out there in the redwoods. Let's go ahead and just kind of keep going. So, Rebecca. So Brett, you're coming in and out, and it's very choppy. We see your amazing spot. Yeah.
Frozen.
So Rebecca, let's have a little conversation for a moment. When you're in your social circles, let's say that you're at an event, when is it that you bring up the deferred sales trust? When people, what are they talking about when it becomes relevant for you to mention, hey, by the way, there's this deferred sales trust that does X. When does that commonly happen?
It comes up in conversation when we're just talking about real estate in general. Some people, depends on what circles I'm in, whether they know I'm in real estate or not in real estate. We talk about how long they've owned their home, those kind of things. I try to do investigating rather than just going, hey, I know this great tool that you might want to use, right? I try and ask a little bit of questions before I start diving into, hey, I know this great tool about it's called the Deferred Sales Trust. You might want to learn a little bit more about it. This might work for you and your circumstances, that kind of thing.
Absolutely. Let's do a little role play real fast.
Okay.
Because you are a luxury home realtor.
Yep.
Lake Tahoe, Truckee area, right?
Yes, exactly. Yep.
So I'm going to be a luxury homeowner.
Okay.
We're at some evening social charitable event, what have you, and we're just having a conversation, okay? And I'm telling you how business always takes me out of town. I'm never here. I don't know if I want to keep my home anymore. What do you say?
Wow, those are some great problems, I would say. Have you? So tell me a little bit more about your business. Are you? Is your home your primary residence, or is it a second home that you have? In the area.
So I have 3 homes. Okay. Just never in the Lake Tahoe area. Like literally this past year, I've been there for 2 weeks.
Wow. Yeah. That's definitely a common thing I hear about. So have you thought about maybe selling your home and using the funds, in different ways and still having the opportunity maybe to rent a home if you want to come to the area, but not have all the hassles of owning a home in the area, all the maintenance, that kind of thing?
I've thought about it, but to be honest, I just don't have time. As well as, I haven't looked at my tax situation. My home has appreciated greatly. It's literally worth twice what it was before, which now that makes it around $10 million.
Wow. So that's a great problem to have. I'm sure you're concerned about tax implications if you were to sell, at $10 million, even if you declared it as your primary residence, you're still going to have a lot of tax implications. So I know of this great tool. It's called the Deferred Sales Trust. It may, would you mind if I ask you a couple questions about your goals and we can talk about it a little bit?
Yeah, we're here. I hardly have any time ever to talk about these things. Shoot, this is a nice charitable event where we're helping everybody else out in the community. So let's go ahead.
Yes.
What questions do you have?
So it's worth $10 million. How much right. Have you done any work on the property at all since you've gotten it?
Just cosmetic stuff, nothing that really adds a lot of money.
Terrific. So sounds like you have, around $5 million in equity in that property, right? And we're here in California, so your taxes are going to be somewhere between probably a third and 50% of your gains there. So we're talking $2.5 million maybe. It's a lot of money.
That's why I haven't spent any time trying to sell it, because talk about a big expense. It's like I have maybe $1,000 a month maintenance. But if I sell it, then I'm going to lose $2.5 million.
Right. And so, have you ever rented out the property before?
No.
Okay. Yeah. So a true second or third home. That's what a lot of people do in the area. So I know this tool. It's called a deferred sales trust. It enables you to actually defer all those capital gains dollars, and then utilize that money and diversify your portfolio if you want. You can reinvest it. Why don't we set up a time where we can sit down and talk about your taxes, get your CPA on the phone, and I'll bring in my partners, and we can all sit down and talk about it. How does that sound? What works for you?
Sure, but again, my biggest problem is time.
Time. Okay.
Social events, and I'm always super busy, always traveling, always out of the country, so it's hard to catch me. Maybe we could do like a Zoom call, but to meet in person is almost impossible.
Okay. Well, Zoom's easy as well. I'm available that way. So what works for you?
Well, who is it you're going to introduce me to?
So I'm going to introduce you to a gentleman named Brett Schwartz. He works, his company's called Capital Gains Tax Solutions. And it's, and the tools to deferred sales trust. Actually, you know what? I even have a great book I can send you, an ebook that talks a little bit about the pluses and minuses about it. I know you don't have a lot of time, but I can send you a link and we can set up a time and have Brett on the phone as well. How does that sound?
Now let's fast forward the discussion. Now we're on a Zoom call with the Brett Schwartz,
right,
and you're introducing me to Brett.
Right.
Okay, go ahead.
Jake, this is Brett Schwartz. I've been working with Brett for a couple of years now. He is the guru of the Deferred Sales Trust. Jake owns a home in the Tahoe area. It's valued at about $10,000. He purchased it for $5,000, so he's got $5,000 in capital gains. And
more zeros.
What?
Not 10,000 and 5,000, but 10 million and 5 million.
Yes, you're right. Yes, a few extra zeros there, right? And Jake owns a couple of homes, so he's never rented this property out, so it's truly a second home for him. And he's just interested in finding out more about the solutions, about the deferred sales trust, and maybe other opportunities will help him out.
Because how I view things right now is I can keep paying the $1,000 a month in maintenance for my home, or I can spend. I think of it as I'm spending $2.5 million in taxes if I sell it. And of course, I would rather not incur that huge expense, because now I've got a $10 million asset that's going to fall down to $7.5 million if I have to pay taxes on it. That just doesn't make sense to me.
So I would need to go into depth on that too. And I'd already probably have emailed Brett and let him know a little bit about the information before we start. So, but yeah, I definitely need to work on my introductions and stuff.
Oh, not a problem at all. And the funny thing here is this is just typically casual conversation that people have. They open up and they share some of their concerns and worries, why they don't make decisions, things of that nature, which oftentimes they're just too busy. They haven't found anyone that can tell them how, and they've never heard of the deferred sales trust before, or they say they have, but they're getting confused with something else.
Right. estate side, I mean, I specialize in taking care of doing everything that needs to get done to get their second home, their third home ready, so that they don't even have to do much on their end to physically get it ready as well. So I always hear that they don't have enough time. What am I going to do with everything? I'm never there. Those kind of things as well. So.
But essentially, sometimes, so that we can get someone to the next meeting in a social setting, we have to give them enough meat so that they bite.
Right. So what would you suggest?
I would say that, hey, you know what? There's a legal financial tool called the Deferred Sales Trust that allows you to sell your luxury home for $10 million, and all you end up paying are attorney fees rather than taxes right now. If you'd like to know more, it's probably the best, most vetted tax strategy that your CPA doesn't know about. And so,
that's great. Yeah.
For you to learn more about it, we need to introduce you to the experts, which, they can teach your CPA all about the strategy if needed.
Got it. Yeah, that's great. Yeah. And it's interesting that you use legal, financial tool as kind of the way to describe it. I mean, if I don't use those terms, do you think they're thinking I've come up with some crazy idea? I don't know.
It just depends if you're like whispering in your ear saying, hey, I know a trick. And they might start shying away from you and just kind of going over something, thinking that this trick is not above board, what have you. But if you, Rebecca, you're like one of the most professional people anybody would ever meet. You come across very eloquent and very, very, one way of saying it is very kind, right? Very kind, very dear, but also trusting. And so they're not going to think that of you. But it's also very helpful that you're expressing things in the terms that also give additional comfort, such as this is legal, this is vetted, your CPA may not know about it, but we have experts who do and teach your CPA all about it, so that your most trusted advisors can give you a head nod after we explain it to you.
Well, that makes perfect sense. Yeah.
It looks like we got Brett Swartz back in the house. We can. You're very muffled. You're like far away, but we can hear you.
This make any difference here? I think
it does, yes.
Okay, hopefully that helps a little bit. I had technical difficulties all morning, the Wi-Fi and everything else. So we'll see how this holds up. So looks like we're recording this, right? So that's a good thing.
Absolutely. We actually just went through a hypothetical scenario where I'm the proud owner of various houses, one in the Lake Tahoe area, and I'm never there. I've been there 2 weeks out of the last 12 months, and I'm just, it's annoying because I'm paying $1,000 every month for maintenance, but at the same time, I'm, not willing to pull the trigger and pay $2.5 million in taxes. So Rebecca was presenting to me, and that I meet with her people, the people that she knows, and she was kind of telling the audience some of the things that she would bring up and mention in order for there to be enough meat on the bone for me to bite. Now,
yeah. So I have a quick question for you. It's a technical question, and I always forget the answer on this one. So Jake, you bought the house for $5 million, and it's now worth 10, right? The gain is still it's $5 million on the property, which is pretty realistic in the area. That if you didn't get a loan for your first $5 million, the capital gains is still only going to be based on the $5 million gains. So do you, the owner, get to pocket that extra $5 million? I know it's because there's debt on the property, I guess.
Yeah, so right now there might not be any debt, but I have basis.
Right.
So whether the basis comes because I got a loan and I didn't pay off the loan, or I paid it all down at once, or what have you, my basis is still established as my basis and doesn't change unless I make improvements or unless I take depreciation, which are my primary home people that do. And I mentioned that I haven't made any improvements, I was just making the math simple. So when you say get to pocket it, I do get to receive return of my principal, the return of my capital, or the return of my basis.
Right.
And it depends on when you take it to, Rebecca, right? So if you do a cash out refi prior to the close up into your basis, you can get that money out not tax free, and also save you on the DST. So we have a deal working on now. This exact scenario. They have like really no debt. They have some basis left, and they want to buy that primary home. They want to move out of California, right? Value of the house is about 1.5. They bought it for like 125,000. Something like
20 years ago.
30 years ago, something like that.
Yeah.
And their basis with the 121 exclusion with improvements is something around 800,000. So what they can do is they can do a cash out refi or a HELOC up to that 800 at first. It needs to be separate from the close of escrow, right?
Right.
Get that cash into their bank account, then sell the asset, have the buyer pay off the debt, right? We'll have the trust in between, right? So the promissory note will be the difference of what the net proceeds are. But in that scenario, they've got the cash out to go buy the primary, or at least have a down payment for the primary, right? Then they can still defer the capital gains tax. The key is understanding what's the adjusted basis, what's the debt, right? And then obviously what's the sales price, and then doing it in the correct order. Make sure that everything's lined up perfectly. It's not something where at the close of escrow you can say, "Hey, yeah, I want my 800,000." Like my 121 exclusion and my plus my improvements plus what I bought it for. It doesn't work that way. At the closing statement says that you paid off X amount of debt at closing. And let's put it this way: in excess of your basis paid or took cash at closing, then it's considered basically constructive receipt. But if we do a cash out refi that's separate from the close of escrow, you can still pay off the debt at closing as long as it's not above your adjusted basis. And so that's the key. Just get the stats, right? Get clear numbers, and then you can run the scenario with them. And if they have time, right? If they don't have time, that's the other challenge. They're like, I'm already in the contract or I'm already closing. Well, can you still do a HELOC? Maybe you still can. May not be able to do a cash out refi if you're under contract, right? But that makes sense?
Yeah, no, it does. It really does. Thanks.
You're good. All right. So I don't know if this is, are we actually really streaming right now, or is it just saying we're streaming?
We are streaming.
Okay, cool. All right. Excellent. So last week we promised that we would do a couple things. We would continue on the conversation of building an effective capital gains tax plan. I'm wondering how Jake and Rebecca's memory is. I think Rebecca's here on defining what an effective capital gains tax plan is financially, maybe a couple bullet points, Jake, and then what personally is an effective capital gains tax exit plan. What did we talk about last week?
Yeah, so financially, the ability to have control over the timing of when you pay taxes. That gives you essentially the control over your largest expense that you typically incur, which is what you send to the government. And once you have control over that, that also lends to the personal freedoms that we speak about all the time of being more in control and having more peace of mind of being able to move in and out of assets without having the biggest obligation or biggest objection of having to pay those taxes and chopping up your assets to do so.
Excellent. Rebecca, do you remember the second one here as far as the investment opportunities, the freedom to invest? So not just having more dollars to invest, but the freedom. What are those freedoms around? What freedoms are they?
Well, you've got, the freedom of time, the freedom of choice. You don't have restrictions on what investments you want. You don't have to reinvest in real estate. You can reinvest in cryptocurrency or who knows what, right? Or just the stock market, that kind of thing. Or
no timing restrictions and no asset class restrictions.
Right.
Also, no lack of liquidity restrictions. I'd also add to that the ability to dollar cost average, as you make these investments, as they make sense, and also to be an entrepreneur too. It doesn't just have to be passive; you can be active, you can be an entrepreneur. So you really have flexibility there. Now, the next one, Jake, has to do with the payment structure and tax flow optimization. So talk about the future payments and cash flow over a longer period of time that unlocks the compound interest in your favor.
Absolutely. So a lot of times we structure this depending on the size and amount of different things so that we're accomplishing the goals and objectives of our clients. With the deferred trust, there's a corresponding promissory note that stays inside of your estate that we typically at least pay up to that promissory note interest amount. And that's income that can come out of the trust that pays towards you while maintaining the principal amount inside the trust. However, not always is that the goal and objective of our clients. Sometimes they wish to also participate and pull out some of their principal over time, and that principal is taxable. But we're able to control how much we're pulling out, which allows the client ahead of time to plan on what taxes will be, or to also institute other tax mitigating strategies to offset the principal coming out of the corpus of the trust, which with the tax rate. So again, it allows for planning, and it allows the client to meet their goals and objectives, and beforehand know what is taxable, what is not, and know how to structure their financial future.
Yep, and to all of that, and to shorten that up, essentially, it's kind of like a spigot or a throttle, right? Like a water spigot where the water can be turned on, it can be turned off, and that means you can delay payments, kind of like an IRA or a 401k, which means you can delay income tax as well as capital gains tax, and then you can take more payments in 1 year where you might need a bigger payment or less. So it's pretty flexible. That's on the DST 1.0, and the 2.0 it's a little more inflexible. It's a part cap gains tax, part interest payments, but it's outside of your taxable estate. But sometimes our clients will do two. And so the key here is the big idea of thinking tax flow mindset versus just cash flow mindset. And since taxes are getting higher and the debt is higher, the national debt, what we're looking at is tax flow planning. It's even more important to do tax flow planning, especially if you created so much wealth. It's preservation, and it's using the tax legal methods and strategies in your favor to unlock compound interest, because we're keeping that money working for you, not only for capital gains tax deferral, but also income tax deferral, which leads to the estate tax benefits, which we can eliminate the estate tax. So if you're ultra high net worth, and by the way, as of 2026, that's basically going to mean 6 million or more single, or 12 million or more, or 12, 14 million married is the estimates. So that is, a very successful person, of course, but it's not as high as you would think as of right now. It's like 24 married, 12 million single is just set to cut in half. So this has everything to do with eliminating estate tax. We can do that without charity, without gifting, without any life insurance. And leading to the last financial freedom, or the reason to make an effective capital gains exit plan, has to do with asset protection and debt freedom. Not having to go into debt is really important right now. Like a 1031 exchange, typically it will force you, if you have any debt on the property, to go into more debt. And asset protection, to be able to be safe from those who might sue you. Okay, which leads into personal reasons. So, Rebecca, out of all these personal reasons, there's effective ways financially we talked about. But what about the personal reasons? What do you like about any of these ones that kind of stick out?
Well, for me, probably the top two, or the first two here, the time freedom and the entrepreneurial freedom. Just the time freedom of not having to make a decision immediately with the proceeds, and waiting for optimal timing to reinvest. And that leads kind of to the second one of the entrepreneurial freedom. For me, reinvesting is reinvesting in maybe another business. I think I'm an entrepreneur by trade, and so is my husband. And so, I think we'll always want to look at business opportunities and those kind of things. So I like that.
Yeah. How about you, Jake?
Cash flow. I'm getting older. Be nice just to take some money in.
If we go back to the example, the role play that we did here with Rebecca, my biggest thing is I didn't want to lose $2.5 million right now. My biggest thing is, hey, I'm paying $1,000 a month in property management fees and things of that nature. Somebody to go and water my plants, what have you, and I have no other reason for keeping my house other than I don't want to give the government $2.5 million right now.
Right. So
that would provide me with some financial freedom, as well as just good economic astuteness in not keeping or maintaining a property that I don't want, that I'm never there, everything else. But at the same time, I'm only going to be paying attorney fees rather than taxes on the sale of the home.
Absolutely. Yeah, so you can be passive or active. You can be retired or entrepreneurial. You can have time freedom for your time, your energy, your travel, whatever. You want to give back and and start a business, you want to give back and start a charitable cause, whatever it is, your time is free because you don't have to be actively managing the property or the business. It also gives you a 1031 freedom. You never have to do a 1031 ever again if you don't want to. You can also rescue or save a failing 1031. We like location freedom. You can move out of that big primary home in California or New York and establish your residency in Florida or Texas or Nevada or Maui or wherever you want to be. You don't have to be tied to that asset anymore or that business in that location that you're in. You also have the ability to give to charity if you want to. Flexibility there. You have estate planning flexibility so that your children don't have to argue about who and what's going to be sold when after your passing. You can do it all right now. They have it all simplified, and cash flow can go out to each individual child according to your wishes and your living trust. You can also separate partnerships. The 1031 exchange typically means everyone must go together. We can separate the partnerships, or even business planning. The partnership can buy one other partner out for a fair price because there's extra money being deferred in tax, and so you can make a deal. It also works for short-term or long-term assets. It can be crypto, stock, business sales. It can be less than a year. We've done land deals with clients out of Texas, so last year especially. So that's some of the financial and the personal reasons. And remember what we said last week. It's really the most effective capital gains exit plan is the one that gives you, combines both financial and personal freedoms, and be able to create the impact that you desire, right, for your family, for the causes you believe in most. And it gives you the flexibility to do all of that or some of that. It gives you the ability to adjust. If there's one thing that COVID has taught us, even this real estate and or stock market, is the ability to be nimble and flexible with planning and execution is so important. The deferred sales trust allows you to have that. So we want you to consider the deferred sales trust. And some of the stats are staggering: $84 trillion for baby boomers in the next 20 years or so. And there's 77 billion in the U.S. alone, and that's $84 trillion worth of assets that's going to pass to the millennials or their children. There's about 10,000 baby boomers turning 65 every single year. 50% of the total net worth is in the U.S. is in commercial real estate businesses and primary homes. It's illiquid assets that are highly appreciated. Again, the deferred sales trust works for all of these different types of assets, whether it's an LLC, whether it's an S corp, whether it's a C corp. You're selling a car dealership, you're a dentist, you're selling a private practice, you're an optometrist, you're a cryptocurrency millionaire or billionaire, you're a investment real estate expert and syndicator or GP or LP. It works for any asset of any kind, as long as it has $1 million net proceeds, $1 million gain. And so we went through who this was not for. We covered a lot of this last week. Covered some of the benefits, some of the freedoms. This is just a quick snapshot of, I say us meaning Capital Gains Tax Solutions, Strategic Tax Solutions, working with Jake and I and Rebecca. You have an opportunity to have all kinds of flexibility with all assets at any time outside taxable state, liquidity, new depreciation schedule. Then being the deferred sale, the 1031 exchange, which we still do, by the way. We're brokers. We love 1031s when it makes sense. But you have to have a lot of things that make sense. What are those things? You have to be okay with just investment real estate, because that only works for investment real estate. You have to be okay with the timing being restricted, 45 days to identify, 180 days close. You have to be okay with inside of your taxable estate, meaning you don't have an estate tax issue. You have to be okay with the asset not and the equity not being liquid. By definition, that is what commercial real estate or real estate is. And an old depreciation schedule. Oh, by the way, can you still buy real estate with a trust? Yes. With a new depreciation schedule, yes. And so we actually think that the majority of the time, if not 90+% of the time, it's always better to do a deferred sales trust, unless you literally have everything on the right side. It's not an issue for you. And sometimes that's the case, and great, do a 1031. It's definitely much cheaper, but that's just a quick snapshot of us versus them. Some closed stories. This always helps to bring it to life. This is David Sloan, client of mine. He exited about $120 million worth of assets across 5 different multifamily properties where he was the GP, general partner, and deferred all of his tax, and was able to reinvest with the funds back into his own deals at any time. He told his full story on YouTube. This is Dave Levinson. For him, he was looking to be really retired. He's been doing this for over 30+ years, hundreds of property exits, and he used this to save the deferred sales trust to save the 1031 and really kind of get his time back and his ability to be retired and truly be passive. This is Dharma. We did it for short-term land exits out of Texas. multiple exits, where he held it for less than a year. Would have been ordinary income tax, but he was able to defer all of that using the DST. Stormy and her husband Jeremy did it for Airbnb exits, and for them, they just wanted to relocate because the Airbnb place that they were once renting and owning, they got new restrictions in the community, and they kind of just shut it down. And so they're like, hey, so they just sold the house to a normal buyer. Then they reinvested the funds with the trust back into another Airbnb in a different location that was suitable. There's another client. He exited a $17 million business sale out of Sacramento. His biggest freedom he wanted personally, besides the financial 40% extra that's in the trust working for him, was the ability to have, location freedom. He wants to move out of California. He wants to, be a little more passive in the business, and he really wants to be the ability to travel more. And so that's where he's looking at Tennessee or Florida to move. Another client named Shay, he was an entrepreneurial freedom dream, which was to sell a business and then start an entrepreneurial real estate development multifamily business, which he was able to do with the trust. The list keeps going on and on. We have clients across the country for sales of primary homes, businesses, cryptocurrency, and yes. And so some of you might be wondering how this whole thing works, and kind of curious why my slides aren't quite loading everywhere. Here we go. But I want to walk through this. Jake, you ready to walk through this?
Do it.
All right, so we got these assets to sell. In fact, see these billboards? This is in Sacramento, next to the Golden One Arena. This is my client. These are his billboards, these digital billboards. So we'll use his deal as an example. A $17 million part of his exit, 40% of tax, Jake. And so, Jake, if he's selling these assets to the trust, and the trust is giving him a promissory note, making payments slowly over time, and he hasn't received any cash at closing, do you see how this would be? No constructive receipt. He's in a tax deferred state.
Absolutely. So, obviously, the trust has its own investments, and the trust is its own entity, right? He retains in his estate the same amount or the same value. It's just been an exchange. Whatever the asset was, moved into the trust, but he retains the promissory note or IOU for that asset in his own hands. But he never receives the proceeds from the sale, so it doesn't ever touch him.
Yep, exactly. Just like a 1031, Rebecca, you see that if the funds would have been sent to a 1031 qualified intermediary, third party unrelated to him, where it's not in his own hands or his own bank account, it's in a deferral state, right, until he moves into another property or asset, or real estate, has to be real estate. But in this scenario, we don't have to do that. Do you see how this works, Rebecca, on that first part of it? He just sells it to the trust, and he gets a promissory note back.
Right, and I love the language that you're using, like the exchange language. It actually mirrors the 1031 exchange.
In fact, most people don't know this, but the 1031 exchange is based upon IRC 453, which is an installment sale. If you think about it, it's sort of just like an installment sale. If you really think through it, the foundation of it is based upon that. A few more rules, right? A few more regulations, but the seller carryback is very well known. So this trustee, by the way, it's our Capital Gains Tax Solutions. We're the third-party trustee. So we're in the business of buying your asset, right, before it sells to the ultimate buyer, all in basically most of the time one escrow, and essentially the trust then sells it to the third-party buyer, and the buyer puts the cash to the trust because it bought it from the trust, and the buyer goes away, he has title, he's gone, and the trust owes all the money back to the seller. So let's do the $17 million example. $17 million is sold into the trust. The trust turns around and sells it for $17 million. It says it bought and sold for the same price. The trust has no gain. And from the seller's perspective, since he hasn't taken any constructive receipt of the proceeds yet, he's in a deferral state until he starts to receive payments. So that's quickly how this whole thing works. That being said, we do have Jake Carpenter on the line. Jake, how are you doing today?
Wonderful. It's good to be here.
Excellent.
I had some technical,
Absolutely. Great.
but I made it.
Yeah, I did too. So it's, we're in good company here. I came in late, and Rebecca and Jake did a wonderful job of kicking it off. So, Jake, any thoughts or questions or feedback for anybody who might be considering the DST for the first time? Jake is part of our Strategic Alliance as well. He's a financial advisor out in wealth advisor out in Washington. And so, Jake, any thoughts for the audience or for anyone who might be listening to this?
No, the community as a whole, the investment community, they're getting older, and they're chasing this idea of freedom and passive income. And while they were younger, the 1031 swap until you drop whole concept worked. They were young, strong, and felt like they had freedom and growing their portfolio. But now the baby boomers as a whole are getting to an age and stage of life where they don't want to deal with trash toilets and tenants. And the idea of trash toilets, tenants, and liability is not freedom to them anymore. So I would say to anyone listening to this or watching this right now, you have a strategy that can provide a foundational element to your planning moving forward. Move yourself from a position of actively being involved with your real estate, actively being involved with your business, actively being involved with your investment activities, and moving yourself to more passive position, and maybe not all at once, but this strategy with the deferred sales trust would allow you to do that slowly over time in selling off some of your businesses, some of your crypto, some of your stocks, some of your real estate, slowly over time transitioning to a more passive position where we can move you into a more passive position, or maybe you're still young and you want the benefit of timing and not having to stay within a 45, 180-day window. And you want to be able to sit and watch and wait for the right time. Maybe that's a year, 2 years, 3 years, 4 years down the road when those real estate cycles and those business cycles get to a point when it's time to jump back in. This quite literally is a strategy that will allow maximum flexibility. It works really well with a team like Jake Miller, Brett Spurts, Rebecca Monson. All of us here are a team to work with your current CPAs and attorneys to make sure that the strategies that you use are going to complement your estate, business, retirement planning as a complement. So we're not solving a problem somewhere and creating a problem somewhere else simultaneously.
Yep. Very well said. And it's all of that with lifetime audit defense, perfect track record, thousands of closes over 27 years, billions of assets used with the deferred sales trust, state and federal audits, all no change, no findings, never had a change or a finding, still batting 1,000, continues to work until it doesn't work, and it's great. It's really an amazing strategy. That being said, I do want to open up for questions for anyone else. We've been talking for a while here. We do have some new folks. Looks like we have Michael on. Hello, Michael. I think Pierce mentioned you might be coming on, so you feel free to unmute yourself and say hello. We can walk through, answer any questions you might have, and or thoughts or feedback you have for us so far. Looks like we have Maria. I think Maria's been here before. Of course, there's Rebecca. We're a little bit lighter today. Usually we're about 10 to 12, but that's all good. It's always great to continue to show up. So, Michael, any thoughts or questions? You can unmute. Say hello.
Yeah, hi guys. Thanks for having me. Intrigued by the process. I've worked on Wall Street for 30 years. I ran Morgan Stanley for Nevada and Orange County, and I've been around the game a while. I've seen stuff like this beforehand. So, usually it's done with insurance product and the attorneys. So the real question is, what happens post sale of assets? It's in the trust. I understand there's a problem in the trust, and until the client actually takes the money, they don't pay the taxes. That's the intent, is that they, as opposed to 1031 exchange where you have to act in a period of time, whatever the business is, whether it's an asset or a business or a stock or whatever the case may be, upon distribution to the client, that's when they pay the tax. That's the point of it. That's the deferral.
Yes, sir. You nailed it, right? So think of it like an IRA or 401k, Michael, right? When do they pay the tax, or when is it taxed, right? Well, it grows income tax deferred and capital gains tax deferred until they start taking that required minimum distribution, or they take some kind of distribution, right? And so the trust is just like that in that scenario, although it's not something you can delay for 10, 20, 30 years. We do need to have some payments coming out. But typically most of our clients, for example, let's say it's a $10 million exit, Michael, and it's in California and it's a $4 million tax liability at a zero basis. They'll have all 10 million in the trust, and it might be based upon their risk tolerance. They might have let's say an 8% over 10-year net of fee type of risk tolerance score, and that's what the interest rate on the promissory note would be. They may delay that payment, $800,000 on 10 million for a year or two, and they may move to Nevada and establish residency and start taking the income from the trust, which would be ordinary income tax. You have a 1099 INT on any of the interest that's accrued and that they take out. They may also take a portion of those payments. They may take 5%, 500,000, and let the other 300,000 accrue and build up until the balloon payment, which is typically in 10 years. You can also have shorter terms, a 5-year term, a 3-year term. You can have a 1-year term if you want to. So it all depends on what their needs and wants are. But most of our clients typically will not dip into the principal unless they need a big amount for a primary home, a boat, or a car, whatever. It's your money, take the money. But most will want it to accrue and build up and have it produce the cash flow for them to live on. So that's the ROI one. Now, if they do dip into principal, let's imagine the first year it's written at an 8%, but let's say they take $1 million in the first year, right? So that difference between 8% and let's say that's 10%, right? Which is the other 2%, that'd be $200,000 in tax, in capital gains tax. That'd be principal, right? So it'd be 9.8 million at the end of that year. They had taken 800,000 and they had dipped into the principal, depending on what we made on that. But so there's a couple little nuances there. But essentially, what you would get if you were the note holder, you get a 1099 for any interest that you've received in the given year. If you took no interest, you get no 1099, right? If you let it delayed, the trust itself has a very efficient way of being very tax efficient at the trust level. So that's the first part. Does that answer the question, Michael? Any thoughts there?
Yeah, of course, the question is, how do I access my money? Everybody's gonna ask, and then what happens when I die? And I assume that you have life insurance components complement when you die. And if they access the money or the principal, they're getting 1099s as opposed to long-term capital gain. They will have 1099 income. So I kept the residency in Nevada since the company relocated me, and I'm not in the field anymore. Real estate investor now, but I'm a perfect example of that. I've got money in real estate. I've got the long-term capital gains that I'm holding, and doing this makes sense if you don't need the cash flow. If you need the cash flow, are you better served in a trust like this where you get you're only taking a portion of it, so you lower your AGI down to a level that makes sense, or are you better served with the long-term capital gain for the amount of money that you take? And there's got to be some type of balance there, right? That's really the question. Who manages that process?
You're thinking really well, and so the short answer is all of us as a team, right? We like to say the dream team, and for someone like yourself who's been doing it for as long as you have and the expertise you have, we kind of become a part of that dream team. Some folks are like, hey, we need the entire dream team, but you probably already have a dream team, or you are the dream team because of your knowledge. But the point is, we're all working as a team. Me as the trustee, let's say Jake Carpenter, Jake Miller as the third-party financial advisor, third-party tax that we work with from the trust, tax attorney and CPA who create the trust. They kind of fill in some of the gaps. But we're typically working with you directly with your CPA and just strategizing taxable optimization. And we're going to say, hey, Mike, how much do you need or want? No wrong answer. It's your money. Take it, right? But we just, we encourage you that for every dollar you're going to take, if it was a California asset, for example, and you had no basis, about 40% of it's going to be taxed. And so how can we be efficient? Another way we can be efficient is by creating capital losses on buying new assets with a fresh depreciation schedule. And so what some of our clients will do is we'll delay payments for a couple of years, let it accrue and build up. And then in the meantime, hopefully maybe buy real estate in a year and a half, which creates an opportunity for a fresh depreciation schedule by partnering with the trust. So you're still in a tax-deferred state, partner with the trust to buy it. No 1031 required. We just did a joint venture partnership with the trust, and that establishes a new basis in which you can get about 80% of it for you, Mike. And the way we structure that, you can potentially do accelerated depreciation on that. Bonus depreciation is 80% this year. Next year is like 60, but so it's not as favorable as right now. It's okay right now. Last year was even better. But the key is we're going to try to create a tax flow dollar loss for every dollar you take. And if you're a real estate professional, which you probably are if you're spending 750 hours or more right? Then you have the ability to also potentially offset ordinary income tax on what you're doing, right? So the answer is it all depends, and this is part of why we get paid to do what we do, because it's not like a one size fits all. Just set up a living trust, pick your beneficiaries, and go away. It's a day to day, week to week, quarter to quarter tax flow planning, but active planning, not just like a tax CPA would just report on it, right? Say, oh, this is what happened. We're strategically working with you. Some clients more hands on, some clients once a year, some clients once every quarter. Just depends on what you want to accomplish, and we're here to help you with that. Is that making some sense? So it's kind of like a family office is the big answer, with more hands on for more complex deals.
Yeah, I get it. I mean, look, this has existed for years. It's only you have to find your dream team alone before you guys do this. Of course, now the question is, what's it cost? Yeah, if the trust owns it, and what's the succession plan for whomever is the trustee, right? And if the company becomes insolvent, or when you guys get hit by a bus, what happens next?
Yep, so I'm the trustee, and funds are typically held, by the way, to answer your question before about where the money goes after closing. It's typically like TD Ameritrade, Charles Schwab, like a Raymond James. Those are the typical places, or third-party banks. Funds never move without your approval or your signature, because you're the sole creditor of this. These are single entity trusts that only do business with you, and if you're married, your spouse. They're never commingled in any personal or other business accounts. You have 24/7 access to view the funds online. Okay, so that's a short answer there for some of those controls that are in place. If I get hit by the bus, I have a succession plan. My brother, if he's on that same bus and we both get knocked out, then the tax attorneys have a few trustees that could be appointed to the trust, and or interviewed, and make sure it's a good fit. So in regards to anything else, Jake Miller, you want to add to that that I didn't catch on, or any nuance there?
No, I mean, just the structure itself, we're not lone wolves out there. There's a lot of people behind us. If at any point in time there's a need, we're constantly doing checks and balances. That's why there's a team around all of us. And if there's ever an issue or a problem, we all work together to solve it or move people around as needed so that you get the best possible outcome.
Got it. I think the thing works. I appreciate you guys taking the time and letting me into it, and we'll talk more. Got no need to.
Yeah, let me give you the fees too, Michael. I didn't mention that.
Yeah, you didn't tell me the fees, right? And then the Benny of the trust, right, is like I die, and my wife or heirs respectively are, the beneficiaries of my trust. Who's the Benny of this trust if I die in our deal? Like, my wife wakes up one day, I'm dead, and she doesn't like Jake's shirt. What happens next?
You're asking him to change the shirt to the other Jake, the Hawaiian shirt, versus just the Jake with the plaid. Yeah, so let's talk about living trust, right? So you have your big living trust, and inside of that living trust, you have assets to pass to your spouse and to your kids, or however you have that set up, right? So what you have now here is a promissory note. That is the asset, right? So you don't own the trust. If you own the trust, Michael, it'd be taxable. So Capital Gains Tax Solutions is the sole shareholder, to be really technical about this, but it owes you all the money, right? And it won't invest or move the money without your approval. So you have all the rights and protections of a lender, right? And so, but if you owned it, you just sold it to yourself, it's taxable. And so it's sort of like a 1031. You don't own the 1031 company, you send the funds there until a later date. Think of it like a long-term 1031 that owes you the money plus a rate of return, but nothing without your approval or your signature. So if you die and you have in your living trust the money to pass, to your spouse, the money goes to your spouse, and you both die, you pass to the kids. And so the promissory note itself, there's no stepped up basis. On the DST 1.0, it's simply the kids can step into your shoes, right? And they can continue the tax deferral. If it's a DST 2.0, we eliminate the estate tax. Your children are actually the beneficiaries of the DST 2.0. And that way they can inherit it outside of your taxable estate, and also capital gains tax free. However, over your lifetime, you're paying and your wife are paying partial cap gains tax and partial interest payments on the payments, the way that it's set up. So there's some nuances, which means sometimes our clients have two trusts: the 1.0 for the maximum flexibility during their lifetime, right? The ability to kind of turn on and turn off and have that flexibility. And then the second one for estate planning, to eliminate that estate tax and have the kids be the beneficiaries. And so they both have their place, and we would map that out based upon your unique fact pattern. To answer the question on fees are pretty simple. There's really two sets of fees, okay? Let's say it's $1 million asset sale, right? You're selling a gas station for $1 million tomorrow, okay? It's a one-time fee for $15,000 to the tax attorney. Covers lifetime audit defense. Simple. In other words, it's 1.5% on the first million. If it were a $2 million asset sale, it would be 1.25 on anything above $1 million. So it'd be 15,000 on the first million, and then let's say it was 2 million, it'd be 12,500 on the second million. So combined, I think like 20. It's like 27,500, something like that, I think. Yeah. So that's how that fee would go one time. Now, the second fee would be for Jake Carpenter and Jake Miller and I, kind of whoever the financial advisor is with the trustee combined. It's about 1.5% to 2% on the AUM. So whatever net proceeds into the trust after closing costs, debt paid off. So let's say $1 million hits the account. It's about 15 to 20,000 on a recurring basis. Okay. However, our goal is to net you typically 6 to 9% compounding rate of return net of those recurring fees over any 10-year period of time. Not a guarantee. We have to go make the investments. That's the first ROI. That's the first set of fees. Any questions on that, Michael?
You know, I understand that completely. You know, that the IRA model is exactly that. Is there a cap on the asset liquidation section? So you have 1.5 million on the first million, 1.2 on the second million. If it's a $30 million deal, is it all 1.2 blended with the 1.5, the first million? Or is
Question. Depending on the size and complexity of the deal, right? The tax attorneys will look at that and determine. You have to ask. You have to talk to them about it. In regards to us, obviously, as the AUM goes higher, our fees go lower, right? I'm just trying to keep it simple at a 1 million.
It's scale and everything, and everything.
Yeah, it's scale. Yeah, exactly. So we'll talk, and as it gets above, the $20 million mark, it's negotiable, and we go through it and work with you. So, the key on top of that is what I always say is, and I made a couple videos on this: how to make the DST an investment, not an expense. Most people, when they first look at this, they think it's just, okay, I'm deferring the 40%, and I might be eliminating the 40%, which are huge, but that's the estate tax and deferring the capital gains tax. We talked about the income tax deferral and or establishing residency in a new state. Sounds like you're already in Nevada, so you're already in good shape there. The last thing would be the ability to get a new depreciation schedule and get the majority of the upside on any future real estate deals that you structure. And so where it can be 100% upside, and you can structure it to get 80 to 98% of the upside with the trust being the silent joint venture partner. So there's some complexity to this, but we'll map it out for you. I'm up against the top of the hour. I've got a call I've got to jump on. I want to thank everybody. I want to encourage everyone, and Michael, we can set up a time to dive into your scenario. These are great questions and thoughts. If you want to get in touch with me, you can go to capitalgainstaxsolutions.com. You can schedule a free, no-cost consultation with myself or one of my team members. If you have $1 million net proceeds, $1 million gain is the minimum size deal. You can also check out the new book, Building a Capital Gains Tax Exit Plan. It's on Amazon. Kevin Harrington from Shark Tank is in the book. We also have Jake Miller, who's on the call here in the book as well. Pretty cool. But Jake, if people want to find you, Jake Miller will start, then Carpenter, then Rebecca. Where can they find you, Jake?
Absolutely. We have a website. We actually have two: alphamarkcapital.com, as well as strategictaxsolutions.com. On either website, you can book an appointment with a member of my team.
Excellent. Jake Carpenter, if they want to find you, where they can find you?
You can call it 509-396-5292 or go to www.carpentercapital.llc.
Perfect. Rebecca Munson, Truckee, Lake Tahoe, real estate luxury extraordinaire. If they want to find you, where they can find you, Rebecca?
Sure. So they can call me at 530-448-9740 or at my website, RebeccaMunson.com.
Amazing. Hey, thanks everybody. We'll see you next week, and have a great rest of your weekend. Bye now.